Imagine, imagine spending 20 years of your life writing this massive 600-page Bible on the exact painstaking mathematical formulas you need to get rich.
Right, a real life's work kind of thing.
Exactly. And then you make 500 times your money by completely ignoring your own book.
It's the ultimate human contradiction.
It really is. It's like, that friend who meticulously tracks their macros for 6 months. They buy the $300 smart scale. They preach about kale to everyone who will listen.
Oh, we all have that friend.
Right. And then they finally achieve their ideal weight, not because of the kale, but because they accidentally got food poisoning in Bali.
That's incredibly accurate, actually.
All that rigid structure just to be completely saved by total chaos.
Well, it highlights this really strange paradox about discipline, right?
Yeah.
Because sometimes building this incredibly rigid set of rules is simply the prerequisite for knowing exactly when and how to break them safely.
Which brings us to the mission of today's deep dive. Welcome, by the way, to everyone listening. Today, we are looking at the life, the underlying logic, and the just massive final irony of Benjamin Graham.
If you're swimming in the finance world at all, you definitely know the titles.
Oh, for sure. He's the undisputed father of value investing. He mentored Warren Buffett, and he wrote basically the foundational texts of the whole industry.
Yeah, Securityanalysis in 1934, and then The Intelligent Investor in 1949.
Bibles. Literal Bibles for Wall Street.
Exactly. Books that are still treated as absolute scripture at major investment firms today. And for this deep dive, we're pulling from, well, his biographical data, some case studies of his actual investments, like his wild ride with Geico summaries of his methodology, and this rather shocking interview he gave in 1976.
And what we find in these sources, when you really look at them, is a man whose legacy is deeply misunderstood. Like, people think he was just this math robot.
Right, just a spreadsheet guy.
Yeah, but his obsession with safety, with these exhausting, unyielding rules, it didn't come from some desire to buy a yacht and, live large. It came from a deep, primal trauma. Because you don't build a giant fortress unless you've literally watched your house burn down.
And his house burned down very early on. I mean, metaphorically and financially.
Right. Set the scene for us.
So he was actually born Benjamin Grossbaum in London in 1894. But his family moved to New York when he was just a year old, and they eventually changed their name to Graham.
Why the change? Just to fit in?
Yeah, exactly.
Yeah.
It was an effort to assimilate into American society and, frankly, to avoid the heavy anti-Judaic sentiment of the era.
So basically, the baseline setting for his entire life was already survival mode. Just blend in, keep your head down, be safe.
Right. And his father owned a somewhat successful porcelain shop, so they did have this brief window of comfort. But then, tragically, his father died.
Which is awful enough on its own.
It is. But almost immediately after that personal tragedy, the panic of 1907 hit. And you have to remember, this was an era before government safety nets. There was no FDIC insurance.
Banks just failed.
They just failed. Savings completely vanished overnight. The family was plunged into severe poverty. I mean, Graham watched his mother turn their own home into a boarding house just to survive.
Man, that does something to a kid.
Oh, absolutely.
Like, if you lose everything when you're 13, you don't grow up dreaming about how to double your money on some risky bet. You grow up obsessing over how to never, ever be broke again.
Yeah, it's a scarcity mindset that never really leaves you.
It's like someone who got caught in a terrible rainstorm once without an umbrella. And so now they walk around in the middle of July wearing a heavy-duty raincoat and rubber boots, just constantly sweating, but thinking, well, at least I won't get wet.
That's a perfect way to look at it.
Sure.
And that psychological scar is the entire foundation of value investing. Because of that trauma, Graham didn't want to gamble in the stock market. He demanded certainty.
He wanted a guarantee.
Right. In fact, he explicitly defined an investment operation as one which, upon thorough analysis, promises safety of principal and a satisfactory return.
Safety of principal, meaning don't lose the original money.
Exactly. If an asset didn't meet those exact requirements, he didn't care what the potential upside was. To him, it was just speculation.
Which is really just a polite Wall Street word for gambling.
Really true.
He drew this super hard line. Investing is like knowing the bridge you are driving over is mathematically engineered to hold your weight. Yeah. Speculation is hitting a ramp in a Honda Civic and just hoping you clear the canyon.
Hoping for the best, yeah.
So he builds this philosophical fortress, right? Yeah. He graduates a salutatorian from Columbia University at age 20, which, wow. and he heads to Wall Street. But there is a glaring flaw in his master plan.
The market itself.
Exactly. He wants mathematical certainty, but the stock market is essentially a giant room full of people who haven't slept, screaming about the future based on what happened like 5 minutes ago.
It's chaotic. The market is fundamentally driven by human emotion, fear and greed.
So how did he deal with that?
Well, to cope with this totally irrational environment using his rational mind, Graham invented a coping mechanism. He created an allegory in The Intelligent Investor that we actually still use today. He personified the entire stock market as an imaginary business partner.
The famous Mr. Market.
Exactly. Mr. Market.
Let's look at Mr. Market, because this is where Graham's observation of human absurdity is it's brilliant.
So Graham proposed this thought experiment for his readers. Imagine you own a small share in a private business, and it cost you $1,000. Every single day, your partner, Mr. Market, knocks on your door.
Okay, ringing the doorbell every morning.
Right, and every day, he offers to either buy your share or sell you his share at a specific price.
But Mr. Market doesn't look at the company's actual ledger, does he?
No, not at all.
Right.
Mr. Market is basically having a continuous psychological breakdown.
He's highly unstable.
Very. Some days, he is wildly euphoric about the future. He thinks everything is going to the moon, and he offers to buy your share for $3,000.
Even though the business hasn't changed.
Exactly. But then other days, he is completely despondent. He's convinced the world is ending, the economy's collapsing, and he offers to sell you his share for $200. His prices have almost nothing to do with the actual profits of your business.
He's like that one emotionally volatile friend everyone has in their 20s.
Oh, yeah.
You know, the one who texts you at 2 in the morning saying, bro, I just bought a domain name. We're going to be billionaires. Life is a movie. And then at 8 in the morning, they text, I burned my post. The universe hates me. I'm moving to a cave.
That is literally the stock market.
But think about how exhausting that is. If a guy is screaming outside your house every single day with these wild fluctuating prices, human nature suggests you eventually get swept up in his drama, right, Brian? How do you actually sit in your living room and just ignore a guy having a meltdown on your lawn?
Well, Graham's incredible insight was that you don't ignore him.
Oh,
You exploit him. You let his emotional instability be the very thing that makes you rich.
I love that.
Graham advised that you figure out the true intrinsic value of the business in a total vacuum. You look at the assets, the hard cash, the consistent dividends, and then you just wait.
You wait for the mood swing.
Exactly. When Mr. Market is depressed and crying on your lawn, offering you a $200 price for an asset you know is worth $1,000, you buy. When he is manic and offering $3,000, you sell.
You just quietly, coldly take advantage of his mental state.
Yeah, it sounds a little ruthless when you put it like that, but mathematically, yes. And this leads directly to Graham's most famous technical concept, the margin of safety. It is the buffer against your own miscalculations.
Now, people often describe the margin of safety like wearing a raincoat just in case it rains, but it's more structural than that, isn't it? It's really an engineering concept.
It is. Think of it like building a bridge. If you know a bridge needs to hold a 10,000-pound truck, you don't engineer it to hold exactly 10,000 pounds.
Because if a bird lands on the truck, the whole thing collapses.
Right. You engineer it to hold 30,000 pounds. That extra 20,000 pounds is your margin of safety. If the steel degrades faster than you thought, or the truck is way heavier than estimated, the bridge still holds.
Because you have to assume you might be wrong.
Exactly. And Graham applied that directly to stocks. If your deep analysis says a company is worth $18 a share, you do not buy it at $18.
You wait.
You wait for Mr. Market to have a terrible day and sell it to you for $10. That $8 gap is your margin of safety. If the economy takes a hit, or your math was just slightly off, your principal investment is still protected.
Which sounds completely bulletproof. But it assumes one massive thing. It assumes you actually know how to calculate that the company is worth exactly $18 in the first place.
Right, which is not easy.
That requires some serious math. And the sources note, Graham literally patented 2 handheld calculators. Like, who patents a calculator? A guy who really, really doesn't want to be poor again. So how was he actually valuing these companies back in the 1930s and 40s before computers?
Well, in his early days, he utilized what became known as cigar butt investing.
I love this metaphor so much. Paint the picture of the cigar butt for us.
Okay, so imagine you are walking down the street and you see a discarded cigar butt just sitting there on the wet sidewalk.
Gross.
Right. It's unglamorous. It's soggy. Nobody wants it. But it has one free puff left in it. And because it's just lying on the sidewalk, that puff costs you absolutely nothing.
Okay, I see where this is going.
Graham was looking for companies that were the financial equivalent of that discarded cigar butt.
Companies that the market had basically left for dead.
Precisely. He was looking for a very specific metric, net current asset value. He wanted to find companies trading for less than their liquidating value.
What does that mean in plain English?
It means if you bought the entire company, immediately fired everyone, shut it down, paid off all the debts, and just sold the inventory and took the cash from their bank accounts, you would make a profit.
Wow.
Yeah, he ignored the factories, the real estate, the fancy brand name. He just looked at the cold, hard-working capital.
So he's essentially buying companies that are mathematically worth more dead than alive. He buys the stock, waits for the market to realize there's a pile of cash just sitting there, takes his one free puff, and throws it away.
It was incredibly effective. But as the market evolved over the decades, those extreme, absurd bargains became much harder to find. So he had to develop broader mathematical rules.
The famous formulas.
Right. The most famous is the Graham number. It's a formula designed to calculate the absolute maximum price you should ever pay for a stock.
And what is the formula?
The formula is the square root of 22.5 multiplied by the earnings per share, multiplied by the book value per share.
Okay, let's translate that out of textbook speak. First, book value, because that's a term thrown around on financial news networks constantly, but I think people gloss over it.
Sure. Book value is essentially the accounting value of a company's assets minus its liabilities.
Yeah.
If a company went completely bankrupt tomorrow, sold every office chair, every laptop, every warehouse, and paid off every single loan, book value is the exact amount of cash left sitting on the table.
So it is the tangible hard floor of a company's worth.
Exactly.
Okay, so he's multiplying the earnings by the book value and then multiplying that by 22.5. Where does the 22.5 come from? Why not 20? Why not 30?
It comes from two very rigid boundaries, he said. Graham believed that a safe investment should never have a price-to-earnings ratio, or PE, higher than 15. And its price-to-book ratio should never exceed 1.5. You multiply 15 by 1.5, and boom, you get 22.5.
But again, why 15? It seems arbitrary to just declare that a PE of 15 is the absolute ceiling for safety, like he just picked a nice round number.
It wasn't arbitrary at all, actually. It has to do with the alternative options available to an investor at that specific time. A PE ratio of 15 roughly translates to an earnings yield of about 6.6%. You just divide 1 by 15.
Okay, math tracks.
Graham looked at the high-grade corporate bond rates of his era, which were much lower. He calculated that an earnings yield of 6.6% offered a sufficient premium over bonds to actually justify the risk of holding equities. So it was a relative safety check against fixed income.
Man. So you have to dig through physical balance sheets. Remember, you don't have an app for this back then. Find the earnings, find the liquid assets, calculate the yield against current bond rates, and do square roots by hand. I'm exhausted just talking about it. It's a second full-time job.
Oh, Graham was fully aware of the brutal reality of this work, which is exactly why he divided the world into two distinct types of investors: the defensive investor and the enterprising investor.
Let's talk about the defensive investor first, because this is basically the financial hammock.
Yes. The defensive investor is someone who is honest with themselves. They want to minimize time, minimize effort, and absolutely eliminate worry. They do not want to calculate square roots on a Saturday.
Relatable.
Right. For them, Graham prescribed a heavily automated, rigid life. You buy high-grade bonds and a diversified list of leading prominent companies.
But even for the lazy investor, his rules were super strict. I mean, the sources say he demanded 10 straight years of positive earnings and an uninterrupted dividend record for 20 years. 20 years.
He wanted absolute proof of stability. He didn't want you checking the stock price. The defensive investor buys these boring, bulletproof companies and then completely renounces any attempt to predict the market. They just hold.
Like putting your money in a time capsule. So if the defensive investor is the hammock, what is the alternative? What if you actually want to beat the market averages and get rich?
Then you must become the enterprising investor. This is the person willing to devote serious, painstaking effort to original analysis. You are reading the tiny footnotes of the financial statements. You are hunting in the gutters for the cigar butts. You are actively trying to outsmart Mr. Market.
It's the harsh truth of the universe, isn't it? You can be lazy and safe, accepting average returns with the defensive strategy, Or you can grind relentlessly for the bargains. There is no magical lazy and rich option. You pay with your time or you pay with lower returns.
Exactly. And Graham, obviously, lived the enterprising life. He ran his investment firm, the Graham-Newman Corporation, with absolute mechanical discipline. They methodically ground out base hits. They never swung for the fences. They completely refused to pay premiums for flashy growth stocks.
And it worked, right?
Oh, it worked beautifully. They averaged about a 20% annualized return over 20 years, absolutely crushing the broader market.
So they spent 20 years clipping coupons, saving $5 here, $10 there, which brings us to the great irony of this entire story. Because the single investment that made Benjamin Graham a legend, the one that secured his massive fortune, broke almost every single rule he just spent decades writing about.
It really is perhaps the most fascinating contradiction in financial history. The company was the government employees' insurance company, which we all know today as Geico.
Right. Long before the little green gecko selling insurance on television, Geico was the ultimate rule breaker for the father of value investing. So this happened in 1948, right?
Yes, 1948. Graham's firm purchased a 50% stake in Geico for $712,500.
Okay, sounds like a lot of money.
It was. But to understand the sheer madness of this, you have to look at his strict diversification rules. Graham preached that you must spread your risk. Usually, no single security ever represented more than 5% of his total portfolio.
And what percentage of his capital did he just dump into Geico?
Nearly 25%. He put a quarter of his partner's entire money into one single enterprise.
The man who wears a raincoat in the summer just took it off and leaped into a raging river. Just YOLO, basically.
Essentially, yes. And furthermore, Geico was not a cigar butt. It wasn't some neglected company trading below its liquidation value. It was an insurance company that had figured out how to bypass agents and sell directly to consumers.
Which drastically lowered their costs.
Right. They were eating market share rapidly. They were, in every sense of the word, a high-flying growth stock.
The exact thing he told the enterprising investor to avoid paying for. He hated paying for future expectations.
He did. He despised it. But he saw the underlying economics of their direct-to-consumer model, and he took the leap anyway. He broke the portfolio limit, he broke the valuation rule, and he held on. And the outcome was staggering.
Lay the numbers on us.
By 1972, that initial $700,000 investment had grown to over $400 million.
$400 million, which, is a decent Tuesday.
Is a $500 bagger.
But the irony is deeper than just the money. The sources show that Graham made more profit from this one single concentrated rule-breaking decision than he did from all the other meticulous square root calculating base hit investments over 20 years combined.
It's wild.
Every single cigar butt he ever picked up out of the gutter was eclipsed by one giant swing at a growth stock.
It's a profound realization. And, he wasn't the only one who saw the anomaly. A 21-year-old Warren Buffett discovered that Graham, his absolute hero, was the chairman of Geico.
Oh, this is a great story.
Yeah. Buffett takes a train to Washington, D.C. on a Saturday, physically knocks on the door of Geico headquarters, and somehow manages to get an executive to explain the entire business model to him. Buffett then put 65% of his own $20,000 net worth into the stock.
A 21-year-old dropping 65% of his life savings into one asset. The master and the student just completely torching the diversification rulebook together.
Pretty much.
So looking at this objectively, does this mean the 600-page book is a lie? Like, was all the security analysis just pointless if the real money came from accidentally stumbling into a massive growth engine?
Well, Graham wrestled with this exact question in his own writings later on. He actually asked his readers, are there morals to this story?
And what did he decide?
His conclusion was highly self-aware. He admitted that one supremely lucky break, or one brilliantly shrewd decision, might count for more than a lifetime of journeyman efforts. But, and this is the vital mechanism behind that lucky break, there must exist a background of preparation and disciplined capacity.
You have to be in the room to get lucky.
And you have to know what you're looking at when you're in the room. Graham's decades of relentless, punishing analysis of understanding exactly how the gears of a business turn. It built his radar. It allowed him to instantly recognize that Geico's direct-to-consumer model wasn't a speculation, it was an asymmetric bet. The discipline gave him the foundation to know exactly when it was safe to break the rules.
The hard work allows you the right to be spontaneous.
Exactly.
Okay, I buy that. It preserves his legacy. But just when you think you've neatly packaged the meaning of Benjamin Graham's life, we hit the final plot twist. And if you are someone who just spent 6 months studying his formulas, this next part is going to physically hurt.
Oh, it really is. We're jumping to 1976. Graham is 82 years old, living in France, shortly before he passes away. He gives an interview to the Financial Analyst's Journal.
This is the Dean of Wall Street, the man who invented the concept of deep dive security analysis, and the interviewer asks him a simple question. Should investors still do all this detailed, elaborate stock analysis to find value?
And Graham's answer was a flat no.
He just publicly negated his own life's work.
It was a stunning pivot. He explicitly stated that he no longer advocated elaborate techniques of security analysis to find superior value opportunities. He acknowledged that 50 years prior, when he started, the data was hidden. If you did the hard work to dig it up, you had a massive edge.
But the world had changed.
Completely. The industry he created had grown too big. Because of him, there were now thousands of analysts on Wall Street reading the exact same footnotes. The secret was out.
So he essentially endorsed the efficient market hypothesis.
He did, which was gaining a lot of academic traction at the time. He concluded that because everyone was doing the deep analysis, the market had basically priced in all the information. Finding those hidden gems through sheer, exhausting hard work was no longer yielding a return that justified the massive cost of the effort.
Wait, so he went from analyzing 600-page ledgers to basically saying, don't bother. If detailed analysis is dead, what was his final system? What did the great Benjamin Graham actually leave us with at the end of his life?
He advocated for a highly simplified quantitative approach, a quant system.
Really, just pure numbers.
Yes. Instead of agonizing over the specific qualitative nuances of individual companies, worrying about who the CEO is or what the next product launch looks like, he suggested using one or two blunt mathematical screening criteria, applying them to a broad basket of stocks, and then just walking away.
Give me an example of this blunt instrument. What does a rule like that even look like?
His final recommendation was incredibly simple. You buy a basket of 30 or more stocks that all share one trait, a PE ratio under 7. Or, alternatively, you buy 30 stocks where the dividend yield is over 7%. That's it.
Just a blanket filter?
Yes. You don't read their annual reports. You don't try to predict their industry cycles. You trust the statistical probability of the group's overall performance. You mechanize the process entirely, which, crudely, removes the temptation to negotiate with Mr. Market.
If you are listening to this right now feeling guilty because you haven't read the latest quarterly earnings report for the index fund sitting in your 401k, Benjamin Graham's final confession is basically your get-out-of-jail-free card.
It really is.
The guy who literally wrote the textbook on overanalyzing everything ended his life by saying, just set a filter on your brokerage app for a PE under 7, buy 30 of them, and go outside. Go live your life.
It is the ultimate evolution.
Yeah.
He moved from qualitative agonizing to quantitative systemization. He realized the human element, our tendency to fall in love with a stock narrative or panic at a scary headline, was our biggest liability.
So we have this incredible full circle journey. A boy born into comfort, plunged into poverty, who creates the most rigorous, exhausting rules of investing purely out of a primal fear of losing what little he has left. He teaches us to laugh at the daily chaos of Mr. Market. He builds the engineering concept of the margin of safety.
Then he hits a legendary home run by breaking his own strict diversification rules to buy a massive chunk of Geico, proving that extreme discipline is simply the training required to recognize a once-in-a-lifetime anomaly.
And finally, in his twilight years, he looks at the massive, complex, anxiety-inducing machine of Wall Street analysis he helped build and says, actually, just keep it simple. Systematic rules beat exhausting analysis.
It leaves us with a deeply layered perspective on what it means to be intelligent with our capital and, frankly, how we spend our time on this earth.
Which leads perfectly to a final, really provocative thought to leave you with today. In the sources, there's a memory Warren Buffett shared about his mentor. Buffett noted that Graham used to say he wished to do 3 things every single day. Something foolish, something creative, and something generous.
And Buffett observed that Graham always excelled at the generous part. He shared his methodologies freely with anyone who asked, effectively giving away his edge to the world.
But look at that first requirement. Something foolish. Here is the father of value investing, the man whose entire career was dedicated to calculating the exact mathematical floor of risk, stating that his daily goal was to actively be a little bit foolish.
Quite revelation.
It makes you wonder, if a certified genius who built a literal fortress of rationality recognized that he needed to schedule time to be foolish, Maybe our modern obsession with trying to make the perfect, highly optimized, zero-risk decision 100% of the time is actually the biggest mistake we can make.
It suggests that leaving room for the unpredictable, the unanalyzed, and, the absurd is a requirement for a complete life.
So as you go about your week, maybe take a page from the guy who wrote the ultimate rule book. Run your filters, demand your margin of safety, but don't forget to leave the raincoat at home every once in a while.